Marissa Gobin, an investment analyst at Bourse, and today we will be reviewing the financial performance of First Citizens Group Financial Holdings Limited, or FCGFH, and Agostini Limited, or AGL, for their respective 6-month period ended March 31st, 2026. We also provide a brief overview on potential investor opportunities stemming from the recently delivered mid-year budget review by the Honourable Minister of Finance. Firstly, let's take a look at First Citizens Group Financial Holdings Limited. The bank reported an earnings per share of $1.68 in the current period in half year 2026 versus $1.77 in the prior comparable period, down 5.1% year-on-year. Net interest income increased 2.4% to $1.05 billion in the current period. This was supported by a 4.5% growth in the group's loan to customers portfolio. Total net revenue advanced 7.3% to $1.5 billion. Profit before tax declined 8.7% from $632.0 million to $576.7 million in the current period. This was due to higher reported non-interest expenses and credit impairment losses. Overall profit after tax declined 4.9% to $422.9 million in the current period. Taking a closer look at First Citizens' profit before tax by segment, its largest segment, retail and corporate banking, accounts for 53% of PBT excluding eliminations and declined roughly 23% year-on-year from $530 million in half year 2025 to $411 million in half year 2026. Its treasury and investment banking segment increased from $258 million to $331 million in the current period, and its trustee and asset management segment increased to $28 million. Taking a look at First Citizens' trailing 12 months earnings per share increased modestly year-on-year from $3.83 in half year 2025 to $3.84 in half year 2026. From a valuation standpoint, the group's trailing 12 months price to earnings ratio has become more attractive over the years, falling from 19.3 times in half year 2022 to 9.9 times in the current period. At a price of $37.91, First Citizens trade at a trailing PE ratio of 9.9 times, relatively in line with the banking sector average of 10.2 times, and offers investors a compelling dividend yield of 6.7%, above the sector average of 5.3%. On the basis of continued revenue growth and an attractive dividend profile, but remaining mindful of higher credit impairment charges and a newly implemented asset tax which weighed on overall profitability, Bourse maintains an overweight rating on First Citizens with a watch outlook for the time being. Moving on quickly to Agostini Limited, or AGL. AGL reported an earnings per share of $1.62 in half year 2026, down 10.5% year-on-year. Revenue advanced 4.5% to $2.9 billion. Profit before tax increased 3.1% year-on-year to $244.9 million from $237.6 million. This was supported by the recognition of a one-off net gain on acquisition, which amounted to roughly $28 million in the current period. Overall profit attributable to equity holders declined 10.8% from $125.2 million to $111.7 million. According to the group, this decline was due to softer domestic economic activity and increased foreign exchange acquisition costs that weighed on the group earnings. AGL's profit before tax by segment, its largest segment by PBT, which is consumer products, increased 31% year-on-year, moving from $121.3 million to $158.9 million. Its pharmaceutical and healthcare segment declined to $80.5 million, and its energy, industrial, and holdings segment declined significantly from $12.5 million to $5.4 million due to weaker domestic activity in the energy sector. Looking at AGL's profitability margins, so its margins have trended lower over the last 3 comparable periods, with its operating profit margin declining from 9.9% in half-year 2025 to 9% in half-year 2026. Similarly, its profit before tax margin declined to 8.4%. At a price of $59.45, Agostini trades at a trailing PE ratio of 18.9 times, below the sector average of 28.1 times, and offers investors a trailing dividend yield of 2.6%, below the sector average of 3%. On the basis of revenue growth, continued acquisition activity, including the recent acquisition of Massey Distribution Jamaica and the upcoming completion of the takeover of Prestige Holdings Limited, as well as relatively fair valuations, Bourse maintains a market weight rating on Agostini with a stable outlook for the time being. Turning to TNT's fiscal update, as recently presented by the Honourable Minister of Finance in his mid-year budget review statement on June 15th, the fiscal deficit for fiscal 2026 is estimated at $7 billion. And it is expected to be financed through a mix of domestic and external borrowing, including support from multilateral development institutions. On the investment side of things, the highly anticipated NIF bond is expected around September 2026, and the planned establishment of the Real Estate Investment Trust, or REIT, which is backed by high-value income-generating assets. Investors should note that the details on the structure and timing remain to be confirmed. And that brings us to the end of this week's edition of the Bourse Report. Please, for more information, please give us a call at 226-8773 or email us at info@boursefinancial.com. Thank you for joining us, and we'll see you next time on the Bourse Report.